Moving forward, now we're going to talk about the option premium. The option premium is a mystery to most people. Most option traders will start by looking at the call options, looking at the put options, and saying to themselves, what can I afford, rather than what is a good position to take. The option premium itself has a very complicated mathematical formula. It's called the Black-Scholes method. Let's move forward with how option premiums are calculated, what goes into them, and when you're on your trading platform and you see the different price points, one of the stocks we've been talking about is Apple. It's the most widely traded option market. The option market itself is just like the stock market. It is a market. It is two people going to the marketplace and buying and selling what they feel is the right decision to make. So how is an option premium decided? Earlier in the course, we learned that the option premium is the price of an option. It's what the seller will receive or what the buyer has to pay in order to have that option. The following factors: moneyness and strike price. So moneyness is also referred to as being in the money, at the money, or out of the money. And the further into the money you get, which means if the stock is trading at $100 and you are buying a call option and you buy the $50 call option, you are in the money already by $50, which is the strike price. So the $50 is the $50 strike. Time to expiration. This is super important. It's one of the main things you need to understand when it comes to purchasing a call option or purchasing a put option, selling a call option or selling a put option. Time to expiration. And let's break this down into the most simple form that we can possibly break it down to. If we need Apple to go from $100 to $110, if we give ourselves 2 days for that to happen, the option itself is not going to be very expensive because Apple will need to do something extraordinary in order for it to go from 100 to 110 in 2 days. However, if we were to buy the same position, hoping that Apple goes from 100 to 110, and we give ourselves 12 months to expiration, that time period, that 12 months, is worth money in the option market. Because what the option market is saying is, we are giving you, the buyer, or I am giving you as the seller, plenty of time for the stock to move in the direction you think it's going to move by the amount it needs to move in order for you to profit. Next is price volatility, and we will also discuss this in a later section. Price volatility, also referred to as implied volatility, is simply put as how much does the stock that you purchased the option on move per day, per week, per month. If the stock you purchase, for example, is Tesla, and the call and put options on that fluctuate more so than normal simply because Tesla could move 5, 6, 7% in one day, therefore allowing someone who purchases a call or a put, as well as someone who sells a call or a put, realize a gain almost immediately because the stock itself moves what could be 8 to 10% per day. I use Tesla as an example because Tesla is an extremely volatile stock. Let's look at the opposite side of the spectrum in regards to price volatility and look at a company, for example, like Microsoft. Microsoft is very predictable in regards to how much money it's going to make and its price action per day, per week. Now, over the course of a year, Microsoft might make 40% rate of return, which takes us back to the amount of time you give yourself for the underlying stock to do what it needs to do in order for you to make money. Price volatility itself is simply the amount of daily, weekly, monthly, yearly movement that the stock makes. The more movement the underlying stock has, the more expensive the premium and the more expensive the option is going to be. Because, as we said, and this is extremely important, the underlying stock can do what you need it to do, whether that be up $50 because you bought a strike $50 out of the money, or go down by $50 because you bought the put $50 out of the money. And the premium is set by the marketplace. And one of the things that I think is also important, and I've mentioned this already a couple times, and it's going to be mentioned more so as we move forward, but liquidity in the option market also will determine the price. And the way that you can see and determine whether or not an option is liquid and is going to be liquid is the open interest. The more liquidity, the more likely the option is priced correctly. Let's move forward. So how does moneyness impact the option premium? As we get deeper into the money, meaning we increase the delta, and delta is a fancy word for the stock option to move almost the exact amount that the stock moves. The further into the money you get, the more likely it is that you will get dollar for dollar on your option contract as you would with the stock. Higher moneyness equals higher price of the option. It's very simple. There is nothing different between the way that an option that is deep in the money prices versus an option that is way out of the money. So let's look at an example. You have a call option trading at $390 today. As you can see, the in the moneyness is going to vary based on what strike price you choose. Now, I think what's also important, and the next graph that we talk about is the option price versus the moneyness or in the money. It's important to understand that the option premium itself, not only is it calculated by the Black-Scholes model, it's also, it really is determined by what is coming up with the underlying stock, which is represented with what's called implied volatility. We will discuss implied volatility in more detail because that is one of the main things to look at when you select an option, click on the buy or sell. You should look directly at the implied volatility as well as the historical volatility, and you should say to yourself, is this option more expensive than normal, or is it less expensive than normal? And once you can decide and understand that, you will understand whether or not you should be buying or selling that option. It will also give you a view into what the marketplace, the stock market, for the underlying stock, for example, Apple, it will give you a glimpse into what the market thinks Apple is going to do. One of the things I'd like for you to do is follow Apple options leading into earnings. And you will see that as we get closer to earnings for Apple, the implied volatility moves higher. And the option premium itself is really based on what the market thinks the actual stock is going to do percentage-wise. So let's say, for example, Apple is trading at $100. And the market thinks that after earnings, it's going to be trading at $120. The option market itself will price in the percentage they think the actual stock is going to move, which is going to make the option either more expensive or less expensive. Depending on what you would like to do, whether it be purchase a call or a put or sell a call or a put, there are strategies that you can use, but there are also times when you should not use them. I don't personally believe in buying an option prior to earnings. I think you should sell it. And the reason being is, as the market determines whether or not Apple is going to do something extraordinary with their earnings, the value of that option is going to explode. As soon as Apple makes the announcement regarding their earnings, it will be after hours. And a side note, Apple reports earnings on Tuesdays at 4:30 every 90 days. You'll see the stock moving after hours up till 8 p.m. Eastern Standard Time. And then the following morning, the market will open up and the option price itself will have a collapse in implied volatility. Because if it has not been directly correlated to what Apple did, the value of that option is worth nothing unless Apple does what you need it to do. So the actual option price itself is going to be tricky to understand. However, we need to look at the amount of time you're giving yourself for the underlying stock to do what you need it to do in order to make money on the position you selected, or based on what could be a short-term move in the stock, as well as what the average price movement is per day. I want to thank you again. The option premium is one of the most popular things to look at and to learn about. All of the different features that you're going to see in the different Greeks, the mechanics, the strike price, time to expiration, all of those things are going to affect the option price. This is something that I'm going to be teaching in a separate course. I thank you for hanging with me. Again, my name is David Malilly. I look forward to seeing you at the next lecture. Take care.